Personal investment management, session 6, in the last session of the first unit. So, in these sessions, we will be looking into the other consideration of investment, in that tax implications and inflations are the two uh, important things. Also, we will be discussing about Unit Trust of India, but not in much detail. Uh, in the previous sessions, we discussed about rate of interest, rate of return, risk and return, profitability, basic concepts of saving versus investment and need of investment, and the principles of investment. uh, Tax, what is a tax? We all know that tax is a compulsory levied by the government on the citizens. There are two types of tax. One is direct tax and indirect tax. Direct tax is the tax where impact and incidence lies with the same person. Indirect tax is the one where impact and incidence lies with a different person. Anyway, we don't discuss much about here. We will be discussing direct tax. Direct tax is tax which is levied by the government on the individual's income. For example, income tax. So we have since it's savings, it's personal savings and investment. The basic tax systems which we discuss here is about the direct tax, that is income tax of India. We have income tax from investment, which comes from income two ways. One is that a security which gets periodic return in the form of dividend or interest. The cash flows accrue regular time. So for that, you have to pay something known as tax on dividend, and which comes under section 56. Earlier it was abolished. It wasn't there because of the fact we will discuss about that. Second was the tax on capital gains. When you are selling the securities, the difference between the price which you acquired and the selling price, difference profit, on that you have to pay a tax called capital gains tax. Now, interest paid on debenture instruments like bond or debenture is tax deductible and allowable expense for companies. From the company's point of view, interest security is tax-free security because uh, already they pay interest as an expense, allowable expense. But in the hands of individual who is receiving this income through the form of interest, he has to pay tax. Taxable, it is taxable in the hands of investors under income from other sources. Dividend paid by companies on the profit after payment of tax. So there is a question that dividend, whether it is taxable in the hands of individual or investor, because already company pays tax and rest of the amount they pay dividend. After paying tax only they pay dividend. So once it's already taxed, is it not a double taxation? That was a question. Yes, it has been that the case earlier because it was abolished. But again, this introduced earlier it was there, in between it was abolished again. It's reintroduced now. Dividend in the hands of individual is also taxable. But as per the latest Finance Act, it is taxable in the hands of investor under income from other sources. Long-term capital gain is of two types: long-term capital gain and short-term capital gain. The capital appreciation relies on sale of securities attract capital gain tax. It's calculated based on sale value minus cost of acquisition with the appropriate index factors for inflation adjustment. Uh, there are two types of capital gain: long-term capital gain and short-term capital gain. So, capital asset, long-term capital asset are the assets which has more than 2 years or 1 year, depending upon the law rules. Attracts low tax rate but less than general income tax. Short-term capital gain tax is higher than long-term capital gains but less than general rate. When you are selling the securities immediately, that's called short-term. But if you are keeping it for long time and then selling it is long-term capital gain. Uh, Tax on income is taxable at par rate, that is at par slabs. Tax on capital gain is taxed in different slabs. It is long-term capital gain attracts some amount, and it's 20%. Now it is reduced in some, it keeps changing, but it's higher. than the lesser than the short-term capital gain tax. Tax on bond fund is regular tax. There is also taxes which may differ later stages you have to pay. Uh, Equity funds, LTCG, equity funds, mutual funds, equity funds, then long-term capital gain tax applicable 10% without benefit indexation. So that is what the rate is, 10% only long-term, but without benefit of indexation. ELSS, equity linked savings scheme of mutual funds with a minimum lock-in period of 3 years. Debt funds, it is taxable at 20% with indexation. So equity funds is 10%, but indexation facility is not available. Systematic investment plan entitles the holder to invest in a convenient periodic installments. Taxation is on pro rata basis. And in addition to that, securities transaction tax is tax on sale of securities at 0.1%. So next is that inflation is also important consideration while investment. What is inflation? Inflation is general rise in the price level without corresponding increase in the output or persistent increase in the average price level. So consumer price index CPI is used to measure inflation. It is the rise in price levels in the economy over a given time period. Monetary policy and fiscal policy tools are used to rein in inflation, to control inflation. So cost of inflation. Due to inflation, there is a loss of purchasing power. Inflation result in consumers' inability to buy same quantity of goods as they used to buy before at current price, because price is increasing, price is increasing. That is why you have to pay more price for purchasing same type of goods. So you have to shell out extra money. They are forced to shell out extra money. Effects on savings. Inflation dents the income from savings because you cannot save, because whatever savings, it's not useful. It gives feeling that spending would have been better, because if you would have already spent on capital asset, it would have been better, because including your savings 1 year. For example, last year to buy one asset, you would have paid 1,100 rupees. 1,000 rupees. Now let's say you invest in securities for 1 year and a bank deposit you invest, you get 1,100 rupees. But the market price of that asset now, because of inflation, is 1,200 rupees. If you had purchased this last year, you would have saved 100. 1,100 you would have purchased. Now you are paying 1,200. So 100 rupees you would have saved, but you lost in the process of because of inflation. So that is the effect on savings. Interest rate also, there is an impact. The bankers raise their interest rate because of inflation. There is more demand for loanable funds. They just like increase the interest rate. International competitiveness also impacted, because internationally our commodities won't be competitiveness because of input prices and other things. Cost of the commodity, production of the commodities will increase. This also affect foreign exchange reserve and export earnings. Foreign exchange reserve and export earnings will be having a severe dent, and there will be condition of uncertainty. People don't know what is going to happen and what is there for the future. So that's it. That's the problem there. Investment may not come, and because of uncertainty, people are reluctant to invest. There will be labor unrest, because there will be a discord between uh, laborers, different types of employer and employees and working class, resulting in frictions. There are different types of inflation on the basis of causes: currency inflation, credit inflation, deficit induced inflation, demand pull inflation, and cost pull inflation. On the basis of intensity, creeping or mild inflation, walking inflation, galloping or hyperinflation, speed is in intensity, government reaction to inflation, also reason. Okay, but the main reasons are two. One is causes of inflation is demand pull. It happens when there is a disequilibrium between aggregate demand and aggregate supply, and aggregate demand being more. When there is more demand free or buy purchasing spree or buying spree, there is people, everybody is buying because they are having more disposable income. So this result in people are optimistic about the future, and with more disposable and less taxes spend more. This leads to inflation, and this inflation is due to demand and excess demand creates price to increase. So this is what the cause for demand pull inflation. Second one is cost push inflation. This is from the push of cost that is raising in the input prices, especially labor cost. Due to the labor cost increase, what happens is everybody will try to you know demand more. The laborers demand more, so that input cost will increase and everything will become costlier. So because of that, inflation happens. That is cost push inflation. There will be built inflation, some kind of inflation always there in because system. Previous increase in prices caused by demand pull or cost push, that will continue. Quantity, it is due to availability of excess money supply in the economy. uh, you know Due to the quantity of money, excess money supply, that is because of the ease money policy, or liberal money policy, or reduction in the bank rate, or monetary policy. Ease monetary policy will result in more quantity that might lead to inflation. Short-term causes: wars, natural disasters, decreases in natural commodities, so leading to more demand and price will increase. So this is how you know this chapter is all about. So we discussed about tax implication and inflation. So that's all about the unit number 1, and the last session of this unit is this. So thank you for watching.